Okay, welcome back everybody. Once again, this is Principles of Accounting 1, Accounting 201. Just want to go over a few things before we get started on Chapter 1 lecture. Just recall that we're in our Moodle shell right here, at the top of it. Accounting 201, the Fall 2020 syllabus link is located right here. Please read before starting any of the coursework, as there is important information in the syllabus. We're currently in the week of August 13 through August 19. We did a short little introduction to the course video right here on August 14th. Pretty much this video, we just went over the syllabus and just went over a few things on how the layout of the shell and Moodle here is set up and what you can expect moving forward in the course. So if you haven't watched this, take time to watch it. I think it's about an hour long or so. I mean, I'm sorry, that's not an hour long. I think it's about a half hour, something like that, give or take. Quick little video, but be sure to watch that and read your syllabus here before starting the coursework. Also, I want to remind everyone to go ahead and introduce yourself. I know most people have already done so on this assignment, so just remember to introduce yourself. Remember, you don't need the book or any content for the course to be able to do this. I just want you to introduce yourself, your name, where you're from, and your hobbies or your interests, stuff like that. And remember, both the online and in-class sections are responsible to post to this discussion forum by no later than August 22nd. I believe, which is this Saturday at 11:59 p.m. You can see here as well the Chapter 1 PowerPoint is available. That's what I'm going to be doing the lecture based upon, as the PowerPoint for Chapter 1 today. So let's go ahead and get into the Chapter 1 lecture. So Chapter 1 is an introduction to accounting and business. We have a few learning objectives we're going to try to get through today. The first objective is to describe the nature of business and also the role of accounting and ethics in business. We're going to want to summarize the development of accounting principles and relate them to practice. The third objective is to state the accounting equation and define each element of the equation. Describe and illustrate how business transactions can be recorded in terms of the resulting change in the elements of the accounting equation. And then the last two objectives for this chapter are going to be to describe the financial statements of a proprietorship and explain how they interrelate. And lastly, objective 6 is going to be to describe and illustrate the use of the ratio of liabilities to owner's equity in evaluating a company's financial condition. So let's go ahead and just jump right on into the chapter here. What is the meaning of a business? I think everyone probably knows what a business is by this point in their life, but pretty much a business is just an organization which basically takes basic resources known as inputs, and these inputs can be like materials and labor, and pretty much they want to turn them in to either a good or a service and provide outputs to the customers or the general public. So pretty much that's what a business is. You just take something like materials and outputs, and you produce a good or service that's going to either help someone out, make their life easier, or something they desire, like shoes or an outfit or something. So pretty much that's what a business is. It's just a group of processes put together and organized to be able to produce goods or services. And the objective of most businesses is going to be to earn a profit. So pretty much what profit is pretty much the difference between the amount that you charge for these goods and services, meaning the amount of money you receive for providing those goods or services, and the difference between how much it costs you or the expense in order to bring those goods and services to market or to bring it to your customers. So that's pretty much what a profit is. It's the difference between what you bring in as money and what it costs you to get that money coming in the door, also known as gross profit. So let's talk about a little bit about different types of businesses. So let's start with the service businesses. So Delta Airlines, obviously we know that an airplane is a transportation service, right? So obviously that's why it's considered to be a service business. Also, the Walt Disney Company, everyone's watched their Disney movies, Lion King, Aladdin, whatever they might be. This is a service, but it's a form of entertainment. So they're entertaining us through their movies and their shows, right? Whereas Delta Airlines, once again, it's a service industry, but they're more concerned on transporting people and stuff of that sort. So those are your service businesses. Another type of business is going to be a merchandising business. A good example of that is going to be your Amazon or your Walmart stores. And they pretty much are general merchandisers, okay? And lastly, we have manufacturing businesses. And these we can think of as like your vehicle companies, like for Ford or Chevy, GM, stuff of that source. And they're going to produce or manufacture vehicles like cars, trucks, vans, motorcycles, stuff of that sort. And then another good example of a manufacturing business in the tech industry would be Dell. And what they focus on, their product of manufacturing is going to be personal computers. So we can see here the three different types of businesses: the service businesses, merchandising businesses, and manufacturing businesses. So just important to know the different types of businesses. So what exactly is the role of accounting in business? Pretty much, accounting is defined as an information system that's going to provide reports to the users. And pretty much these reports are going to just summarize economic activities and conditions of a business, meaning their strengths, their weaknesses, what they're good at and bad at. And this can all be derived from the financial data that we see. The condition of a business, like at a point in time, the financial strength of it, meaning its assets compared to its liabilities and equities, or like the profitability of it, how it performs. So we can measure that on an income statement based upon how much of a net income or net loss a company has and how it expends its cash. So the process by which accounting provides information to users is as follows. First, we need to identify the users. So who exactly are the users of these financial statements? They could be a whole bunch of different types of users. They could be individuals like myself or yourself that are just interested in buying stocks or bonds, right? So we'd be interested in the strength of the company or how they perform. We would want to know this because if we're going to give them money, we're going to have the hopes of getting a return on our money. So we're going to want to make sure that they're gonna do with our money as we hope they will, or they have the capacity to be able to generate revenue and produce a return for us. So users can be individuals, they can be banks, they could be customers, suppliers, whoever they might be, and all different types of capacities of users here. The first thing we want to do is identify the users, because that's going to be important as to assessing the user's information needs, because all users are different. Okay, so we have to assess what users' information needs are. Then we obviously want to design the accounting information system to meet the user's needs, right? So obviously, what good is a system if it doesn't relate to the user's needs? So we want to make sure those are in sync with one another. And we obviously are going to record economic data about business activities and events. So that's what we're accounting. Obviously, we're accounting in a business. So what we're accounting in a business is those economic activities and events, right? We want to prepare accounting reports for users. So we want to be able to have something tangible that users can look at and say, hey, okay, well, this is where their strengths are. This is where their weaknesses are. They tend to be spending money on this. They tend to, be bringing money in because of this. So whatever it might be. So just prepare the accounting reports for the users. So pretty much accounting can be used as an information system. That's pretty much what it is. We're relaying information to the users. So like we said, step one, if we can see up at the top here, we want to identify users, right? So usually you can group these users into two different groups, right? We'll have an internal set of users and an external set of users. The internal set of users is going to be comprised of like your managers and your employees. So we're going to take this internal data and try to use it for the benefit of the company to maybe become more efficient or whatever it might be, produce better products or services. So internal information. So that's one of the identified users is the internal users within the company, like its managers and employees. The second one will be external to the company. The external users would be comprised of investors, creditors, customers, or the government. So these are all external users that actually have a different type of information that they might need as opposed to the managers and employees of the internal side of the company. So from that point, the second thing after we've identified the users, we want to assess the user's information needs. And obviously, they can differ between external and internal views on what type of data is actually relevant for the decision-making process. So from that point, after we assess the user's information needs, we go to the third step to design the accounting system. Once the system is designed, then we'll record the economic data. And then ultimately, once the data has been recorded within the ledger and in the accounts, then we have prepared the accounting reports, which is the financial statements, the external financial reports that is the end result for the users to use to make to base their decisions upon. So let's talk a little bit different. So obviously for the internal users, they're going to be more concerned with the managerial accounting. So this is pretty much an area of accounting that provides internal users with information. So it's called managerial accounting or management accounting. Management accountants or managerial accountants are most often employed in business and are employed in private accounting. So meaning they're either going to be working for a not-for-profit or a corporation or a government, as opposed to be providing a fee or a service to those outside where accounting firms do in the public sector. So managerial accountants usually are working within industry in the private accounting industry. Next, we have financial accounting. This is the area of accounting that provides external users with information called financial accounting. Now, the objective of financial accounting is to provide relevant and timely information for the decision-making needs of users outside of the business. Pretty much the users outside the business, like we said, those are investors, creditors, the government, the customers, suppliers, stuff of that sort. So they need to have this financial information to be able to make the decision useful, to make their decisions that are going to be useful for whatever their means are of what they want to get accomplished. And general purpose financial statements are one type of financial accounting report that is distributed to the external users. Now, ethics is going to be very important, and it play an important role in both accounting and in business. I think everyone can pretty much infer why this would be so. Obviously, business deals with a lot of money. Obviously, money, a lot of people like to get their hands on money, and a lot of times people might do something that's a little unethical in order to obtain that money. And really, being in business and in accounting is a perfect situation to be in, to either be ethical or unethical. And I really want to just stress the fact that you really need to have a really, really solid understanding of ethics and practice in accounting and business. Just because, for one, it's not cool to screw people out of money, and it's not good to lie to people. I don't think anyone likes being lied to or being misinformed, especially when it comes to their hard-earned money that they might invest to try to grow their funds or their portfolio forward. So ethics is very important in accounting and business. Another thing I want to point out here, if you have a strong ethical base or a foundation and make the right decisions, then it could save your job. It can make you perform better and get promotions, and it could also, most importantly, save you from going to jail or prison or being disbarred, whatever it might be. So the objective of accounting is to provide relevant, timely information for users' decision making. The accountants must behave in an ethical manner so that the information they provide users will be trustworthy and thus useful for decision making. Ethics are moral principles that guide the conduct of individuals. I think that everyone here in this course, at some point in time in their life up to this point, has been faced with some type of an ethical dilemma. I mean, whether it be, holding a door for somebody or slamming a door in someone's face. If you see that someone like an elderly person or elderly couple is having trouble crossing the road, are you going to help them get across the street, or you just going to do nothing to help them? If you see something that's related to accounting and business, if you see a scenario where someone paid too much for something but they have no clue about it, we're never going to follow up with the sale, and it was a one-time deal. Is it better to go ahead and just make the lick on them and keep that money, or should you notify them and say, hey, let me go ahead and give you this money back that is rightfully yours, because that's an ill-gotten gain, because really they didn't owe it to you? So really, point being here is just ethics is very important in accounting and business, and just it's good to stay morally grounded, And a lot of times you can just go treat yourself, with the golden rule here. Treat others as if you were to be treated. Okay, accounting and business fraud. Speaking of ethics, to show why ethics is so important in here, let's just go through it. I'll just go through the first three of the five here. You all can read through this on your own time. I don't want to just bore everyone reading verbatim here, but let's just look at some example of some of the past frauds that have occurred in business and accounting, particularly. Let's start on the left-hand side. You can see list the company. The middle is the nature of the accounting or business fraud, and then the end result of what happens because of that fraud. So the first company we look at here is Computer Associates International Incorporated. The nature of the accounting or business fraud was they fraudulently reported in its financial results. The result of that was the CEO and senior executives were indicted. 5 executives pled guilty and $225 million in fines. Enron, this one you're going to hear a lot about in accounting and auditing, and if you decide to stay in the accounting field, not go towards management or other areas. But Enron, what brought about eventually the Sarbanes-Oxley Act of 2002, the nature of their accounting or business fraud was the same thing. Fraudulently reported its financial results. The end result, the company went bankrupt, the senior executives criminally convicted, and more than $60 billion in stock market losses was realized by individuals that invested into the company. So you can see here, just imagine the gratitude and that this had, or the magnitude of what this was on people that were at retirement age, that had already worked their whole entire their careers of their good earning years in their career, and then invested into this company and then lost everything, all due to the top executives just fraudulently reporting its financial statements and making it seem as it was something that it wasn't. And that's exactly what Enron did. The fraudulent reporting, the way they were doing it was they had shell companies, they were hiding the liabilities, they were over-exaggerating their assets, their financial performance, and pretty much was just getting a bunch of people to buy into a bunch of BS is what it was. Last one here, we'll look at HealthSouth. Overstated performance by $4 billion in false entries, and it eventually led to the senior executives being criminally convicted. So as you can see here, ethics is very important. Not only can it ruin your life, it can ruin a lot of other individuals' lives, and it can also just make a company cease to exist by going belly up or bankrupt, as is the case with Enron. So long story short, you might get ahead in the short run, but in the long run, it will catch up with you, and it will not be worth it. Some more on the role of ethics in accounting and business. So what went wrong with these managers and companies? Pretty much the answer to the preceding question normally involves one or both of the following two factors. Pretty much, they just didn't have that great of an individual character to begin with. Their moral compass was off. They just weren't that great of a person to begin with. And then the next thing, the culture of greed and ethical indifference just pretty much took the best of them. They still knew morally, their moral compass. They knew that, hey, this is not right, but they saw that big financial gain real quick for not having to do anything. So they just went with it and ran with it and just did it. And, a lot of times this can come from pressure from executives wanting you to just skew the data and cook the books, in other words. And whatever it might be, it could be just, folding the pressure to keep your job because they might fire you. But the best thing to always do is just follow your moral compass and just do what's right. So what are the guidelines for behaving ethically? First of all, identify an ethical decision by using your personal ethical standards of honesty and fairness. So obviously, I think at this point in time, we can always identify when we're at a crossroads in a dilemma and what type of an ethical decision that has to be made. Whether there's either a right one or a wrong one. Or it could even be the case where you're indifferent and you really don't know the difference as to which way you should go. And if that's the case, then you should seek professional advice from someone who would know. Next, you want to identify the consequences of the decision and its effect on others. Once again, sometimes this is known and sometimes it's not known based upon the level of knowledge you have pertaining to the work that you're performing. Then you want to consider your obligations and responsibility to those who will be affected by your decision. And then ultimately make a decision that is ethical and fair to those affected by it. One thing you always remember as an accounting profession, especially if you go on and earn your CPA and work in the public sector or in private industry, public is your middle name for certified public accountant. Okay, so public should always be your best interest over your own personal interest, because you really are facilitating a lot of trust between the people who know what's going on and the people who are just buying into it. So pretty much information asymmetry, which just means a breakdown of information, okay? So pretty much to follow these guidelines for behaving ethically as we've went through these 4 guidelines here, and you should be good. And like I said, everyone should know by now in life, for the most part, what's right and wrong. So what are some good opportunities for accountants? I know we're sitting here learning about accounting, but why are we going to learn for it? I mean, is there a benefit of learning it? So what type of opportunities are available if you actually go the path and become an accountant? So accountants who provide services on a fee basis are said to be employed in the public accounting. So these would be accountants that work for like the big 4 accounting firms. They provide tax and audit and advisory services, compilations, what agreed upon procedures, whatever the engagement might be here. So those accountants are said to be employed in the public accounting. So they're pretty much helping other firms and other businesses to make sure they're in tax compliance, make sure they're in, their accounting is going as it should, and just give them really good sound consulting advice. Accountants employed by companies, government, and not-for-profit entities are said to be employed in the private accounting. So this means you work in the private industry pretty much. So you actually work for an individual firm, be it a public company or a private company. Maybe you work for the government. Or maybe you work for a not-for-profit entity, maybe like a college or a university or a hospital. So those are employed in private accounting. Okay, so public accountants who meet a state's education, experience, and examination requirements may also become certified public accountants, which this is the golden standard, or the black belt, as you will, for the accountants. Another thing I want to point out here, which I know most of you all will take the course, is managerial accounting, but CMAs, certified management accountants, or cost management accountants. These are going to be geared more towards your private accounting firms for working for governments and more on the managerial side. Like I said, those are going to be more the internal aspects of it, whereas the CPAs are more on the public end of it. What I want mainly here with the with the opportunities for accountants, I just want you all to know that there's a lot of opportunities for accountants. You don't necessarily have to be sitting behind a desk with some glasses and a suit on and a big stack of papers and a calculator punching away on your calculator all day. I know a lot of people think that that's the life of an accountant, but really you could not be more wrong if that's what your view is as an accountant. Not saying that they might not ever look like that at work, because there's at times where you have to crunch the numbers, and that's just the nature of the beast that we're employed in here. But I just want to make sure that the opportunity is endless. You can work in all different sectors. So here's just a few accounting career paths and salaries. These are going to be the sources from Robert Half 2019 U.S. Salary Guide and from Robert Half International Incorporated. But pretty much the accounting career track and private accounting. Then once again, these are going to be the accountants that are employed by companies, governments, and not-for-profit entities. Some of the career options here these are some of them, but not limited to just these: bookkeeper, payroll clerk, general accountant, budget analyst, cost accountant, internal auditor, information technology auditor. So that's stuff that you could see in a career path in the private accounting. Another good thing to note is if you're going to go into private accounting and work for an actual firm, everyone always wants to get to that C-suite, meaning the chief executive officer or chief financial officer, chief whatever it is, whatever chief position it is we're talking about. The quickest way to a C-suite, if you want to be a CFO or CEO, is probably through that of the accounting path. Most of the times, most CFOs and most CEOs are that of a CPA or have a very strong background in the accounting side or finance side of business. That's not to demean or say the other areas of business is not important, because they are just as important. This is just a piece to the puzzle, and every piece is just as important to make up the whole picture that we're looking at here. But just pointing out, and you can do the research and the homework and see that most of the time these upper level positions are held by those that have a strong financial and accounting background, and which makes sense because they're going to need them to understand the books and what's going on within the operations of how we got to that end result of what's on the books. Some of the salaries here, annual starting salaries, you can see they range anywhere between mid 40s to low 50s here, and I'm sure that if you get on there and look at other sites, it depends on obviously where you're living. The cost of living factor is going to determine that as well. Some certifications at this level: certified payroll professional, CPP, certified management accountant, CMA, one I just spoke on earlier, certified internal auditor, a CIA, or certified information system auditor, a CISA. That in the accounting career track for public accounting. And once again, the description of this is accountants employed individually or within a public accounting firm in audit, tax, management, advisory services. The average annual starting salary there shown here is $47,000. And once again, that could be much different in areas of higher cost of living, or maybe even a little lower in areas that are a little lower cost of living. And pretty much the main certification here is going to be that of a CPA, which is a certified public accountant. It's also important to know that the other certifications in the private accounting sector are very useful as well when going to work at a public accounting firm. Mainly so because when you're advising your clients on management advisory services, your CMA could come really in handy, because you have a better understanding of the internal operations and variances and stuff, break-even points and stuff of that sort. So you'll be better able to advise your clients in those areas than just being an actual CPA. Okay, next, generally accepted accounting principles, GAAP. So this can be known as generally accepted accounting principles, GAAP. So financial accountants follow GAAP, generally accepted accounting principles, and preparing the reports, right? So within the U.S., the Financial Accounting Standards Board, known as the FASB, has the primary responsibility for developing accounting principles. So they promulgate GAAP, pretty much, meaning promulgate the accounting principles. Securities and Exchange Commission, known as the SEC, I'm sure everyone's heard about them at some point in their life. They have the authority over the accounting and financial disclosures for companies whose shares of ownership stock are traded and sold to the public. So that has to be on a public forum or public exchange for the Securities and Exchange Commission to have control or authority over those companies. So any company that is publicly traded on a forum or exchange with securities being traded and sold to the public have to adhere to the Securities and Exchange Commission. Many countries outside the U.S. use generally accepted accounting principles adopted by the International Accounting Standards Board, known as the IASB. Okay. And so let's look here. So pretty much within the U.S., you have the FASB, and then outside you have the IASB. What is the business entity concept? So activities of a business are going to be recorded separately from the activities of its owners, creditors, or other businesses. Okay, so pretty much this concept is going to limit the economic data in an accounting system to only that of the data that relates directly to the activities of the business. So pretty much what they're saying here with the business entity concept, that it's its own individual. So say that I'm an investor and 5 people out of this class invest into this business, okay? So we have skin in the game, right? Meaning we have money that's our money is tied up into the operations of that business. But they're not going to, that business, within that business's accounting records, they could care less about what's going on in our personal life and our personal checkbook and everything. They're not going to account for our activities with our household purchases and expenses or stuff that we bring in on the side, right? So they're only going to be concerned with what's going on within that business. Like I said, that concept limits the economic data in that system and that accounting system only to that data that's related to that business. That way we can actually see how that business entity stands on its own, and we can evaluate its performance and its strength and its financial position and its cash flows to be able to evaluate that business, right? And to be able to make decisions based upon that business. So that's what the business entity concept is. It's viewed as its own individual entity. Let's talk about different forms of business entities. So obviously businesses can come in many different forms of entities. And based upon what type of entity, business form you want to choose, it's based upon, for one, what type of industry you might be in, what you're looking to get out of it tax-wise, how you want to pay your taxes, what regulations you're going to have to adhere to, because every different form of a business entity is subject to different forms of tax structures and ownership structures and so on and so forth. So it's very important to know what type of a business entity or what form of a business entity you're dealing with to be able to know how to approach the accounting for it or the regulations tied to it or how the ownership structure is going to be built. We'll start with the proprietorship. That's going to be owned by one individual, also known as a sole proprietorship, right? The characteristics of it is 70% of business entities in the United States, easy and inexpensive to organize, resources are limited to those of the owner, and it's used by small businesses. A good example of that is A&B Painting. And the next form of a business entity is a partnership. And this is going to be owned by two or more individuals, obviously, because if you're in a partnership with someone, then you're going to be partners with either one other person or a number of individuals. This makes up constitutes about 10% of business organizations in the United States, combined with limited liability companies. Combines the skills and resources of more than one person. So if you're looking to build a good firm, maybe one person's good at tax, another person's good at audit, another person's really good at internal controls, stuff of that sort. So you're going to bring in all these different personalities and all these different professional skills that these person have and all these attributes and make you a more sound business, right? So that's a good benefit of a partnership here. A good example here is Jones and Smith Architects. A lot of partnerships, a lot of law firms and accounting firms that operate as LLPs, limited liability partnerships. We'll get into that later on as we move through the business acumen. Another form of a business entity is a corporation. This is going to be organized under a state or federal statute and as a separate legal taxable entity. So this one here is an actual separate legal taxable entity, right? And what I mean by that is it truly does stand on its own, even in the laws of the IRS and in the eyes of the IRS as a separate legal taxable entity. Proprietorships, partnerships, and LLCs are most likely going to be known as a pass-through entity. So it's going to pass through to the individual or to the owners. So that's what we mean by the corporation being a separate legal taxable entity. This is going to generate 90% of business revenues, the corporations are. 20% of the business organizations in the United States is going to be that of corporations. Ownership is divided into shares called stock. Can obtain large amounts of resources by issuing stock, and it's usually used by large businesses. Good examples here is Alphabet with like Google, Apple, Ford Motor Company, and Twitter. All big companies here, all incorporated within their states, separate legal taxable entities and other state and federal statutes. The next and last one here is the limited liability company, an LLC. Now this combines the attributes of a partnership and a corporation. So 10% of business organizations in the United States, once again, combined with partnerships, often used as an alternative to a partnership. It has tax and legal liability advantages for owners. So one of the cool things about the LLC is you can get the tax benefit of that as a proprietorship or a partnership. So it can be a pass-through to you. But you can also obtain the legal liability advantages of that as a corporation. So you're limited as to what people can come back on the actual owner outside of the actual business itself. Also known, one thing known as a corporate veil. It's hard to pierce a corporate veil, but if you pierce a corporate veil, meaning this is tying to corporations, then you can actually go after the owners. That's not very likely, though, for that the corporate veil is pierced. So that's what the legal liability advantages are for owners of the LLCs. Is they have the legal liability advantages, limited liability of that of the corporation, but the tax advantages and the tax structures of the pass-through of the proprietorships and partnerships. Okay, and a good example there is the Mosel and Farmer CPAs LLC. Okay, now let's talk about a time period concept. So pretty much a time period concept requires a company to report its economic activities on a regular basis for a specific period. So what do we mean here? So pretty much a time period concept means in order for us to be able to evaluate the performance of a company, it needs to be broken into periods, right? So usually it's going to be a fiscal year, like a calendar year, the most commonly used fiscal year, right? Because a year is usually the actual the accounting period, the time period concept, right? Important note here, there could be interim dates, so like months, weeks, months, quarters, but usually it's going to be done quarterly and it's going to be done annually, okay? And good to point out here that the calendar year is the most commonly used fiscal year. It's also good to note here that corporations may follow other periods as fiscal years, meaning that they could start the year on June 1st, be the start of the year instead of January 1st, and then on May 31st instead of December 31st. So that's what we mean by corporations may follow other periods as fiscal years. Okay, so pretty much time period concept is we're breaking this indefinite life of a business because a business is assumed to be that of a going concern. And what I mean by a going concern is it's supposed to last indefinitely, right? So if it's a going concern, it means it's going to be around for longer than a period of a year, right? So if it's going concern, if we think a business is going to last indefinitely, we need to break that business that has an indefinite life down to the period so we can evaluate it. That's all we're talking about here is the time period concept, is breaking it down. This right here is just an example of what I just said, how it could be different. A company's fiscal year could begin on August 1st, 2007 and end on July 31st, 2008. As you can see here, it could start here and end here as opposed to starting on January 1 and ending on December. So that's all we're talking about here. It's really just by choice. Now let's get into the cost concept. So under the cost concept, amounts are initially recorded in the accounting records at their cost or purchase price. So remember the cost concept, the amounts initially recorded in the financials are going to be at their original cost or purchase price. Let's look at an example here. Aaron Publishers purchased the building on February 20th, 2002 for $150,000. Now here's some other amounts that are related to this purchase that are shown below. Now recall this pertinent date here, February 20th, 2002, right? They published it for $150,000. Well, here's just other information that's tied to it. Price listed by the seller on January 1, 2002 was $160,000. Aaron Publishers' initial offer to buy on January 31st was $140,000. The effective purchase price, the amount they actually purchased the building for, that was Aaron Publishers purchasing it on February 20th, was for $150,000. The estimated selling price on December 31st, 2007 was that of $220,000. Assessed value for property taxes on December 31st, 2007 would be $190,000. So out of all this data, the only relevant piece of information that we're concerned about as regards to the cost concept for when we initially record in the accounting records or in the general ledger is going to be the purchase price on February 20th, 2002 of $150,000. All of the other data in terms of making this recording it or realizing this or recognizing this in the statements is only pertains to the purchase price, the amount paid on February 20th, 2002. All other data is irrelevant here. Some more on cost concept. So Aaron Publishers records the purchase of the building on February 20th, 2002 at the purchase price of $150,000. Once again, the other amounts listed have no effect on the accounting records. So we're only concerned with the money we paid to acquire the title for that piece of property, right? The cost concept also involves the objectivity and unit of measure concepts. So pretty much the objectivity concept is going to require the amounts recorded in the account records be based on an objective evidence. So only the final agreed upon amount is objective enough to be recorded in the accounting records. So the objective evidence, meaning, bill of sale or whatever the receipt is, that's the objective. That's the objective enough evidence. So the evidence is objective enough to record it, right? So we know that's the pertinent data there. So that's the final agreed upon amount is the objective enough to be recorded in the accounting records. The unit of measurement concept, pretty simple. It just requires the economic data to be recorded in dollars. So dollars is the unit of measurement or unit of measure, okay? That's what the unit of measure concept is. Everything we see in the financial statements within a U.S. company, the unit of measure concept is going to be that the economic data must be presented or recorded in U.S. dollars, okay? So let's go over a little cost concept exercise here. So let's assume on August 25th, Gallatin Repair Service extended an offer of $400,000 for land that had been priced for sale at $500,000. Now on September 3rd, Gallatin Repair Service accepted the seller's counteroffer of $460,000. On October 20th, the land was assessed at a value of $300,000 for property tax purposes. On December 4th, a national retail chain offered Gallatin Repair Service $525,000 for the land. At what value should the land be recorded in Gallatin Repair Services records? Well, as we can see here, it gives us the answer. Under the cost concept, the land should be recorded at the cost to Gallatin Repair Services. We know this amount is $460,000 because on September 3rd, Gallatin Repair Service accepted the seller's counteroffer of $460,000. So, meaning if they accepted the offer, then they're going to purchase that land for $460,000. And if you recall, for what we just went over with the cost concept, all that other data is irrelevant other than what the final agreed upon price was, which is in this case $460,000. So that's where we're going to record that land, and that's what that land is going to be carried at on the books, right? Okay, now let's talk about the accounting equation. This is very, 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 very important. You need to learn this accounting equation, know it, live it, breathe it, sleep it, however you want to learn it. It's very important. This is going to make your life so much easier when it comes to accounting. The resources owned by a business are its assets, right? So we know assets are something that are of value, that a company expects it's going to turn us value. It's of value, right? So it's a resource owned by a business. So the resources are known as assets, right? The rights of creditors are the debts of the business, and they are called liabilities. So the rights of creditors. So obviously a creditor is someone who's going to lend a business money. So if a creditor lends a business money, the business has a liability to repay that money to that creditor. So that's why the rights of creditors are the debts of the business, and they're the liabilities of the business. So liabilities is something that we owe to someone else, right? Assets are resources by business. Liabilities are something we owe. The rights of the owners are called owner's equity. So we have owners, remember, and they have rights too, and that's owner's equity. So since stockholders own a corporation, the rights of the owners of a corporation are called stockholders' equity, right? So stockholders' equity is going to be the rights of the owners of a corporation. So the accounting equation is assets equals liabilities plus owner's equity. Once again, the accounting equation is assets equals liabilities plus owner's equity. Recall, assets is resources owned by a business. Liabilities is those obligations that we have to meet, that we have to pay out or just resolve by delivering services. And owner's equity is going to be the rights of the owners. So that's the owner's equity. Basic assets equals liabilities plus owner's equity. Here's just another visual of it. The resources owned by a business are assets. That's the one side of the equation. On the other end of the equation, we have the liabilities plus the owner's equity. The rights of creditors are the debts of the business. And the owner's equities are the rights of the owners. So pretty much assets equals liabilities plus owner's equity. I cannot stress enough how important this equation is. Like I said, learn it, love it, live it, whatever you got to do, just make sure you know it. All right, now follow along with me on this exercise here. I know it can get a little cumbersome or a little tedious from time to time, but just pay attention here to what's going on here. We're going to do just a little example exercise of the accounting equation here. We're going to apply some transactions and see how the equation reacts to these transactions. So let's say John Jews is the owner and operator of Eurostar, which is a motivational consulting business. At the end of its accounting period, which is December 31st, 2008, Eurostar has assets of $800,000 and liabilities of $350,000. Using the accounting equation, determine the following amounts. So part A, what would owner's equity as of December 31st, 2008 be relating to this data here? So let's recall, remember? assets equals liabilities plus owner's equity. So we know on the left side of the equation, assets it's given, it's $800,000, right? Liabilities is also given, we know that's on the other end of the equation. So if assets equals liabilities plus equity, so then what does equity have to be? Easy way to look at that is the difference between 800 less 350, which would be $450,000. Let's take a look at the next slide here for part A. Here, remember, here's the equation. Assets equals liabilities plus owner's equity, right? Assets was given 800,000. Liabilities was also given at 350,000. But we also know the owner's equity. This is the unknown here, right? The great old unknown, the X. Find X. Remember this in account or in your math classes? So this is the unknown. This is pretty basic right here, though. So therefore, if the assets is 800,000 and liabilities is 350, then we know the difference has to be 450 because 450 plus 350 equals 800,000. So the owner's equity as of December 31st, 2008 is going to be the difference between 350 and 800, which is 450. Got that? Pretty simple, right? Now let's go to part B. Now let's look at a year after this point. Let's now look at owner's equity as of December 31st, 2009. Now let's assume that the assets increased by 130,000 and liabilities decreased by 25,000. All right, and this all took place during 2009. So for part B, first determine the change in owner's equity during 2009. Okay, so remember our equation here, assets equals liabilities plus owner's equity. So assets, once again, was given, the change in assets was given, which was 130,000. So we're going to have this in here as a positive number right here, 130,000. The change in liabilities for the year was also given. The liabilities decreased by 25,000, so we're going to plug this in as a negative number. And we still have the unknown of owner's equity, how it changed through the year. Well, if assets increased by 130,000, liabilities decreased by 25,000. So we need to find the number, the plug of what's gonna net us at 130 from negative 125. So the only way we can get that is if we would add 155,000 to the equation. So therefore, owner's equity is 155,000. Because negative 25,000 plus 155,000 is gonna yield 130,000. So therefore, assets still equals liabilities plus owner's equity. So the unknown here of the owner's equity, the change in owner's equity for the year of 2009 is 155,000. And we're going to infer this information from the changes in the assets and the liabilities through the year because we know it's part of this equation. Assets equals liabilities plus owner's equity. So the next thing we want to do, we're not there yet. This is just merely the change in owner's equity during 2009. But what they're asking for, if you recall, and the question is owner's equity as of December 31st, 2009. So all we've accounted for is the actual changes in the assets, liabilities, and equities, which we calculated to be 155,000. Next, we want to add the change in owner's equity during 2009 to the owner's equity on December 31st, 2008 to arrive at owner's equity on December 31st, 2009 as follows. So recall, owner's equity on December 31st, 2009 was $450,000. Or owner's equity on December 31st, 2009 is going to equal the 450,000 owner's equity, the balance on December 31st, 2008 that we derive right here, the 450,000 we solved for here on part A. Then we're going to add the change in owner's equity of the 155,000 during 2009 that we solved for right here. So we're going to take the beginning owner's equity, which is the ending owner's equity for 2008. Remember, anything that's always ending, the ending amount for 2008 will be your beginning balance for 2009. So your beginning balance plus the changes of 155 is going to give us our end result of 605 for owner's equity as of December 31st, 2009. So we find the beginning owner's equity. We take that, the ending one here becomes beginning in 2009. We add the change in the owner's equity from the changes in assets and liabilities and owner's equity from that happened during 2009. And then that'll give us the end result of the ending number of December 31st owner's equity of 2009 of 605,000, because 450 plus 155 equals 605,000. I hope that makes sense to everybody here. If it doesn't, just go back, read through it, and watch this again. Just rewind back and watch it until you get it, and just keep reading through it. It's pretty straightforward. You really just have to just really think through the equation here, because assets have to equals liability plus owner's equity. So every change that's accounted for on one side has to be accounted for on the other. And we're gonna get farther into it as we get into this lecture. So let's talk about some business transactions in the accounting equation. So first, let's talk about what a business transaction is. A business transaction is an economic event or condition that directly changes an entity's financial condition or its results of operations. So anytime a transaction occurs, the results of operations are going to change, as is the financial condition. Because at the end of the day, the results of operations are going to be closed to the financial condition of the company. And we'll get to that later on in the semester. But pretty much for now, a business transaction is pretty much an economic event or condition that directly changes the entity's financial condition or its results of operations. All business transactions can be stated in terms of changes in the elements of the accounting equation. So once again, the assets equals liabilities plus equity. Remember, every single transaction can be stated in terms of the changes in the elements of the accounting equation. And what do I mean by business transaction? For example, if we're in business of selling merchandise and someone comes up, they buy a t-shirt, bam, we give them the shirt, they give us money, we enter it into the point of sale, bam, transactions occur. That's a business transaction. That's what we're talking about right here. Now let's apply some transactions to this accounting equation and see how it moves with these transactions. So let's start here, very simple here. We're going to start out with only two components of the accounting equation. We're going to start out with assets and owner's equity. So we're omitting liabilities right now. So let's assume on November 1st, 2003, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions, okay? So $25,000 in a bank account in the name of Net Solutions, okay? So pretty much if he's putting $25,000 in the bank account in Net Solutions, the Net Solutions asset of cash, the most liquid asset, which is a current asset, most liquid asset of a company, cash, increased by $25,000. So assets, we can see here, the only asset we have right now is cash, which was the deposited $25,000 from Chris Clark into the company's bank account. So assets increased by $25,000. But if the assets increased by $25,000, then the owner's equity also had to increase by $25,000. And it's going to be known as Chris Clark's capital. So that capital, the $25,000, belongs to Chris Clark because he's the one that deposited $25,000 into the bank account. So just follow along with me. So as of right now, after just transaction A, when Chris deposited that $25,000, the company's assets increased $25,000, and the owner's equity increased $25,000. So right now the equation's in balance. Assets equals owner's equity. Let's look at another transaction. And we're gonna be building upon these transactions. So it's gonna look a little cumbersome, a little like a lot of stuff's going on, but if you just pay attention, you got the first transaction. Now we're gonna compound on that. We're gonna build upon that, okay? Because we're gonna use those assets to keep moving through these transactions. So once again, we're still only dealing with two elements of the accounting equation, that of assets and owner's equity. We've still omitted liabilities at this point because nothing has triggered a liability yet. So now let's assume on November 5th, 2003, Net Solutions paid $20,000 for the purchase of land as a future building site. Okay, recall from the very beginning, Chris Clark dumped $25,000 or deposited $25,000 into the bank account. So the balance at that point was $25,000, and the owner's equity, which was all just the money sitting in there, was $25,000 to Chris Clark. So that was from transaction A. Now let's look at B. So it says once again, Net Solutions paid $20,000 for the purchase of land as a future building site. So if you can see here, this transaction has no effect on owner's equity whatsoever because it's going to stay the same, right? Owner's equity stays the same. However, now you see assets. We have two different types of assets. All right. We now have land that the Net Solutions just purchased for $20,000. So we have to account for all the assets though that the company has. So recall we have the $25,000 cash that Chris Clark originally invested into the bank account or put into the bank account. Then Net Solutions turned around and spent $20,000, right, for land. So we're going to decrease the balance in cash by $20,000. Therefore, the new balance in cash will be $5,000. But now we've gained another asset. Now we purchased the land for $20,000, right? So now we're going to record another asset on the books of $20,000. But see here, the overall effect with assets is unchanged. Assets still reads $25,000, even though we went through a whole other transaction and the composition of the assets has changed. Now there's two different types of assets. It's overall asset, the amount of assets has not changed. Therefore, the owner's equity hasn't changed. You can just see it just moves down $25,000 because now the only thing that's different is the form of owner's equity. Now, we have it in land and cash, and it's all owned by Chris Clark still. So I hope everyone's following that. He put the cash in, $25,000. That was his capital. Then the company spent $20,000, reducing cash to $5,000. The $20,000 was spent on land. Remember the cost concept. This is what the land cost us, so we're recording it on the books at $20,000. Hence the $25,000 overall assets. So look, we're still in balance here with the equation. Assets are still $25,000 to the owner's equity of $25,000. The only thing that's changed here is now we have two different types of assets. Let's throw another transaction in here. Now we're gonna throw in the component or the element of liabilities into the accounting equation. So now we have the full-blown equation being in use now. We have assets equals liabilities plus owner's equity. So transaction C says on November 10th, 2003, Net Solutions purchased supplies for $1,350 and then agreed to pay the supplier in the near future. So pretty much what we mean here is Net Solutions is receiving supplies, right? They purchased $1,350 worth of supplies. But we didn't pay for it right now. We purchased it on account with our supplier. So we still owe them the money. We've already received the assets, but we still owe them. We still owe them for the assets. So we've endured a liability with the supplier. So let's take a look at our equation down here. Remember, as from the previous slide, the cash balance was at $5,000. We had land at $20,000, and we had the Chris Clark capital at $25,000. Okay. Now on this transaction, remember on November 10th, which is transaction C in the blue here. This is the difference, the relevant transaction that we're talking about. Net Solutions purchased supplies for $1,350. Well, supplies is another asset, okay? It's another current asset. So now we've just incurred another asset, right? So assets, nothing changes on the left here. We just have more assets now to account for instead of just cash and land. So now the third transaction, we're receiving supplies. So our supplies increases by $1,350, right? So now let's take a look at the total assets. Now we have $26,350 in assets, or just total in assets. And that's being made up of cash of $5,000, supplies of $1,350, and land of $20,000. Notice here, we received the supplies, right? So we have an asset. So we've gained an asset. But we're still in balance because now we've incurred a liability, which brought into the last element into the accounting equation, the liabilities. So at the same time, supplies increased by $1,350. Accounts payable are also going to increase by $1,350 because remember we bought it on account. So it's an account payable. We bought the supplies on account payable to the supplier. Okay? So because we agreed to pay the supplier. So accounts payable is a liability to Net Solutions. So notice here, accounts payable is a liability. It increased by the same amount in which the asset increased by $1,350. Therefore, liabilities plus owner's equity, which is the opposite end of the accounting equation of that of assets, increased proportionately to $26,350 with assets. So take a look. Assets equals liabilities plus owner's equity. We're locked in tight still. $26,350. So that purchase of supplies for $1,350 increased assets, but it also increased liabilities because we haven't paid for it yet. So therefore, our accounting equation is still intact. Okay? Once again, the liability created by a purchase on account is called an account payable. Okay? Once again, account payables are a liability to a company because it's an account that is payable to a supplier who has supplied goods or services to us. Okay, so therefore, it's going to be counted as a liability. It's going to keep that equation intact. Because remember, assets equal liabilities plus equities. Items such as supplies that will be used in the business in the future are called prepaid expenses. Okay, these are known as assets. So think of it this way. Think of a prepaid expense as this. Say you are a big sports fan, and particularly you love the NFL, you love football, and say your team just made it to the Super Bowl. Well, man, you've been dying for your team to make it to the Super Bowl. So you're going to that Super Bowl. You know, come hell or high water, you're going to this game. So you're gonna buy a ticket to go to that game. So say you get on Ticketmaster, wherever you're buying your ticket for the Super Bowl, because your team's there, they're about to win the Super Bowl this year. So you buy a ticket, right? Well, whoever you bought the ticket from owes you that service still because you have prepaid the expense of going to watch the game. So until you have actually physically went and watched the game that you've paid to watch, you have a prepaid expense, which is an asset because you've spent your hard-earned money to purchase a ticket in which the NFL has not honored by giving you the show, i.e. the Super Bowl game that you paid to watch. So anytime you prepay an expense in which you have not actually used that expense up, it's an asset because you've prepaid for it. So that's what a prepaid expense is. It's related to buying a ticket to a sporting event. Until you've actually went to that sporting event, then you have an asset. Even though it's an actual expense, it's a prepaid expense. So accounts payable is something that a company receives on account from a supplier. So the assets are increasing, the payable is increasing as well because it's a liability. We have not paid for it yet. Same thing, if we prepay for a service, then we've already paid that company for the service that they have not provided. Therefore, it's an asset, right? So it's going to be a prepaid expense. And we'll get into these later into the terms. I just want to make sure everyone's on the same page. Let's add another transaction into the mix here, into the accounting equation mix. Okay, once again, recall we have all elements of the accounting equation are already in effect because they've all been triggered now. Okay, so one of the previous transactions that's already transpired has triggered an asset, liability, and an owner's equity. So we're in full-fledged here with this accounting equation now. So now let's assume a business earns money by selling goods or services to its customers. Okay, this amount of money that is earned is called revenue. Okay, so when a company sells goods or services to its customers, that's a revenue producing activity. Okay, the main activity in which a business is even created for. Because remember, if you recall at the very beginning, a business is a group of activities usually to create money and revenue, right? A profit. So these revenues is the activity of producing a revenue is selling a good or service to its customers. So let's assume on November 18th, 2003, Net Solutions received cash of $7,500 for providing services to customers. Okay. So if Net Solutions is receiving cash of $7,500, cash is what? Cash is an asset. And particularly, it's a current asset, right? So cash is an asset. So if Net Solutions is receiving a cash of $7,500, then go back to our cash balance. Remember, it was $5,000. If the company is receiving cash, then obviously assets are increasing, all right? Money's coming in the door, so money's increasing. Our account's coming up. So now instead of $5,000, we have $12,500 in the cash account. Supplies and land, nothing's changed. All hold true here. We're receiving cash, right, for services to its customers. Okay? So therefore, assets are now up to $33,850. So what about the flip side or the opposite end of that equation? So if we provided services and we're receiving cash, we know assets are increasing here. So assets went up. So something has to go up on the liabilities and owner's equity. So if we provided a service, that's called a revenue, right? So we're receiving the cash. The other end of that thing has to be fees earned, which is a component of equity, of owner's equity, right? Because if we've earned that, it's equity to a company. So fees earned is going to be plugged in here, plus $7,500. Long and short, this is your debit entry, because assets are debits, and we're going to get to this later. I'm going to really focus in on making sure everyone knows double entry accounting, because that'll help explain this too. But for now, just know assets increase because we provided a good or service. And at the same time, by providing a good or service, assets are increasing and equity is increasing as well, because we've just created a revenue. So there's our fees earned, $7,500. So therefore, the liabilities and owner's equity increase proportionately to that of the assets of $33,850. I hope this is making sense to everybody. And you can, like I said, this is just compounding and building upon these transactions that we went over previously in these slides. Main thing to know is assets equals liabilities plus owner's equity. So a change in here has to be a change in here, right? Let's throw another transaction in here. Or this is still relating to transaction D right here that we just went over. So revenue from providing services is recorded as fees earned, right? Fees earned. We saw that here. Fees earned. That's how it's recorded. Where there's the money coming in and it's revenue, so that's recorded as fees earned. That's what this is telling us right here. Revenue from the sale of merchandise is recorded as sales, right? So if we're going to sell an actual tangible piece of merchandise, like if it's an actual tangible, then it's going to be a sale. If it's as a service, like an intangible, like a service, something that doesn't have something physical to it, then it's going to be fees earned. Others examples of revenue include rent, which is recorded as rent revenue, and interest, which is recorded as interest revenue. So let's example about rent. So let's say I own a building and I'm renting it out to a tenant. When they pay me rent to the landlord, I'm going to record that as rent revenue, because that's the main purpose of having a rental unit, is to produce rental revenue, right? That's the purpose of being in the rental business, of owning assets and leasing them or renting them out, is to earn rental revenue. So that's why rent is accounted for as rent revenue. Interest revenue. What could trigger interest revenue? Let's say our company has some excess cash sitting around, and you don't want to just have money just sitting around. For one, it could be susceptible to be stolen, susceptible to fraud, something like that. But also, you want to grow your money. So usually when companies have free cash flows or free money sitting around, they'll invest it into securities or bonds. Let's say we buy bonds, and we earn interest revenue on that. So in order for us to give the money to another company by buying their bonds, so they could raise capital on their end, we're gonna expect some interest revenue to come back. The price of us lending them money. We're not just gonna give them money for nothing. So that's what interest revenue is. If we're in the business of buying bonds or making loans, for example, a bank, then the bank's gonna record interest revenue when you pay that. I think everyone probably has a vehicle or a car note, or maybe a mortgage payment, maybe something of that sort, and can relate to that. There's always going to be a time element and an interest element attached to the principal. So if you're making payments, or student loans, everyone's going to have student loans. When you make a payment on a monthly payment, a portion of that is applied to principal, a portion of it is interest. That interest thing here we're talking about is interest revenue. Okay, now let's talk about the account receivable here. This is an asset, and it's a claim against the customer. So on the flip side of account payable is something a firm owes to a supplier, or someone who has supplied us with a good or service that we've ordered on account. So we still pay it, right? An account receivable, on the other hand, is something we've done on the flip side of that. So now we're on the other end. So we have a receivable from a company. So if the company owes us, then we set it up as a receivable, meaning we've already delivered our product, our service, our good, whatever it might be that we're providing as a firm. then someone else, we provided to them on account. So now we've checked their credit and we've said, okay, hey, you're going to pay us down the road, but we're going to give you this. There's usually terms of when you sell on account. Each company develops their own terms, but usually when you sell that on account, then you have an asset called accounts receivable. So this, we'll get into that in more detail, but just know an account receivable is an asset. It's something that another person owes you. An account payable is a liability, something you owe them. Let's throw another transaction into the accounting equation here. Once again, remember all elements are already been triggered by previous transactions. So now we're just getting more into detail and just picking into more of what items belong within each element. Okay. So now let's say during the month, Net Solutions spent cash or used up other assets and earning revenue. Okay. So anytime that a company expends cash or uses up other assets in order to earn revenue, this process of earning revenue is going to be referred to as an expense. So once again, an expense is anything that a company incurs in order to produce revenue, right? So you're either going to expend cash or other assets in order to earn revenue. And remember, the key here is earn a profit. Remember, you want your revenues to be higher than your expenses, okay? So any cash spent or any consumption of assets to turn this revenue or to produce this revenue is known as an expense. Okay, now let's look. On November 30th, 2003, Net Solutions paid the following expenses. They had wages, which would have been paid to employees. So, you work at a company, you earn a check. That's what we're talking about here. The wages expense of $2,125. They had a rent expense of $800. Utilities like power, electric, water, gas, stuff of that, sewage was amounted to $450. And then we had some other miscellaneous expenses of $275. So obviously it says Net Solutions paid the following expenses. So obviously, if we're going to spend cash or use up other assets, right? That's an expense to a company. In this case, it said that Net Solutions paid the following expenses. So if they paid the following expenses, pretty much they're saying they used cash, right? Which is an asset to be able to pay these wages and stuff. So let's go over here to our accounting equation. We have assets on the left here. So Net Solutions paid the following expenses. So the sum of these expenses is going to equal $3,650, right? Remember, Net Solutions paid the following expenses. Therefore, cash is decreasing. We're going to use or consume cash in order to be able to fulfill the liabilities of rent, utilities, and miscellaneous expenses and wages and all that, right? Because these are all liabilities of the company. So if we're going to use cash, we're going to decrease cash from $12,500. We're going to back it out, less it. Money's going out the door here, $3,650. So now our assets have decreased by $3,650. And particularly the cash account has decreased down now to $8,850 for a total of assets of $30,200. So now where are we going to see this on the other side of the equation? Is it going to be in liabilities or owner's equity? Okay, let's see here. Let's think about this. We paid with cash. Okay, so that's not going to have any effect on liabilities. Okay, because it's going to come straight out of the equity of it. So you see your wage expense is going to reduce owner's equity by the relative amount, $2,125. The rent expense is going to reduce it by $800. Utilities expense by $450. Miscellaneous expense $275. This is just itemizing where the actual expenses go, how they're hitting against owner's equity. It's reducing owner's equity, but the same way the assets were reduced on this side in the cash account. So there we can see by reducing the owner's equity relative to the amount of cash that we reduced by Net Solutions paying the following expenses, we can see that our assets still equal liabilities plus owner's equity of $30,200. So we're still intact here in the formula. Let's look at another transaction. On November 30th, 2003, Net Solutions paid creditors on account of $950. Okay, let's think about this. Once again, Net Solution is paying creditors on account. Okay, let's think about what we've talked before. So if Net Solutions is paying creditors, that means they're going to use cash to pay creditors, okay? So we can see our assets, once again, same thing we just went through. We're paying creditors. So our cash is going to decrease by the amount in which we paid on account to the creditors of $950. So we're using the asset of cash to pay our creditors on account. So cash will be decreased by $950. Now our ending balance of cash is $7,900. Okay, reducing our overall assets to $29,250. So now what about on the other end, liabilities and owner's equity? If we're paying creditors on account, obviously if we have creditors on account and we're paying them, we're satisfying our creditors, then obviously recall accounts payable is a liability. If we're settling that liability or we're paying those creditors that we had on account, $950, then the liabilities must be reduced. The accounts payable needs to be reduced by $950 because now we don't owe them the full $1,350 because we've now paid them $950 cash, which reduces assets, which at the same time reduces liabilities by $950. So we can see here our assets still equals liabilities plus owner's equity for a total of $29,250. Let's look at another transaction. On November 30th, 2003, Chris Clark determines that the cost of supplies on hand at the end of the month was $550. So that's how much we're saying after they looked and determined, okay, we got this stuff on hand. These are our supplies. It's going to cost us $550. That's how much this stuff cost us. So the cost of the supplies on hand not yet used at the end of the month is $550, right? So thus $800, $1,350, the beginning amount of supplies that we can see here, minus $550, so $800, the difference, okay, of what the ending balance of $550 from the beginning balance, so the difference between the two is $800. So thus $800 of supplies must have been used during the month. So this decrease in supplies is recorded as an expense. So let's look at this. So obviously, if our supplies is decreasing, right, because our ending balance is $550, whereas our beginning balance was $1,350, we've used or consumed $800 worth of supplies on hand, right, or the supplies that we had on hand. So obviously, we know supplies is an asset, right? Supplies inventory is an asset. If we're reducing supplies, if we've used $800 worth of our supplies, we have to reduce our supplies inventory account from $1,350 by $800 that we consumed or used during that period to leave a net result of supplies on hand at the end of $550, which matches what they said. So if we're reducing the supplies on hand here, it says obviously we've used that, because remember, anything used up, any supplies or assets used up in order to create a revenue or produce revenue is going to be treated as what? As an expense. So it's saying here the decrease in supplies is recorded as an expense because we're consumed or we've used these supplies. So assets are decreasing. At the same time, supplies expense, which is going to directly reduce owner's equity by $800. It's going to reduce it by $800. Therefore, keeping our accounting equation of assets equals liabilities plus owner's equity completely intact and in balance at $28,450. Make sense? Let's look at one last transaction. Transaction H. On November 30th, 2003, Chris Clark withdrew $2,000 from Net Solutions for personal use. Remember, it's his money. He's an owner. He can make a drawing. When an owner makes a withdrawal from an account, it's known as a drawing. Okay. So obviously, if Chris Clark is withdrawing $2,000 from Net Solutions for personal use, obviously, if he's pulling money out, cash is an asset. So therefore, on the left side of our equation, assets, cash has to be decreased by $2,000 because he's pulling it out. Cash is coming out the door, right? So cash balance will be reduced by $2,000 from that of $7,900 to $5,900. Okay, leaving assets at $26,450. So remember, if the money Chris Clark originally put in was counted as owner's equity, so if he pulls it out, if he put the money in, it increased owner's equity. If he pulls it out, therefore it's going to decrease owner's equity. So that drawing that Chris Clark made reduces the cash account by $2,000, which reduces our overall assets by $2,000, while at the same time, it's going to reduce owner's equity by $2,000 by Chris Clark's drawing. So it's going to reduce it, therefore keeping our accounting equation, assets equals liabilities plus owner's equity, intact at $26,450. Hope this is making sense and everyone can follow through with what we're going here. This right here is just a table. It's a summary of all the transactions that we had. You can list it here. It's listed here of what it all it is and where it's at. This, like I said, this is just pretty much just sums up. It's a summary of all the individual transactions we just had. I'm not going to go through this summary of transactions for Net Solutions because I feel that it could be too cumbersome and it could confuse what I just went over. So if you want to take time and look at this is just a summary. It kind of puts everything in a one-stop shop here for you to look and see without flipping through all the other slides. And you can see all the relevant transactions. Like I said, I'm not going to really focus in on this right here because I don't want to confuse anybody. I think it's easier just to stay with the individual transactions and just see how the individual transactions affects the actual accounting equation. So like I said, take some time here if you want, look at it. If it starts confusing you, don't even look at it. Just move on or just keep it on the individual items. But pretty much it's verbatim. It's just showing you step by step from the different steps here on the left-hand side and moving over. But like I said, I'm not going over that. But just know that that's just the summary of transactions in which we just went through from A through H. So now since we've dealt with some transactions, let's talk about some types of transactions that actually has a bearing or an effect on owner's equity. So the types of transactions that are going to have a direct effect on owner's equity are going to be owner's investments. So obviously we saw that Chris Clark, remember, he dumped that 25 grand into the bank account. So the owner's investments increased owner's equity, right? Owner's withdrawals, remember the drawing Chris Clark made of $2,000, it reduced owner's equity, right? So that's why it's going to reduce it here. Okay, now what about income statement accounts here? Meaning revenues and expenses. Revenues are going to increase owner's equity. Okay? Expenses are going to decrease owner's equity. And we can see this, we can infer this from the information we looked through the relevant transactions when we went through the revenues and expenses. So these are going to be the types of transactions that has a direct bearing or direct effect on owner's equity. Owner's investments increases it. Owner's withdrawals obviously decreases it. Revenues increases it. Expenses decreases it. The reason these increase or decrease it because net income or net loss is going to be closed at the end of the reporting period to equity, meaning to retained earnings. Net income is closed to retained earnings. Net income is an item on the income statement. And equity or retained earnings was a component of stockholders' equity, and it closes to the other. That's why this has a direct relation or a direct effect on owner's equity, because the periods are closed to owner's equity. Okay, let's look at an example exercise of the transactions. So let's say Salvo Delivery Service is owned and operated by Joel Salvo. The following selected transactions were completed by Salvo Delivery Service during February. Okay. The first transaction, they received cash from owner as an additional investment of $3,500. Okay, pretty much. Let me jump to the back. So what we're wanting to do here is, like I said, they have the Salvo Delivery Service owned and operated by Joel Salvo. They had these transactions during the year, okay, or during the month of February. They're listed 1 through 5 here. Pretty much what they want us to do is they want us to look at these transactions, then evaluate and indicate what the effect of each transaction is going to have on the accounting equation elements. Meaning the assets, liabilities, or owner's equities, drawings, revenue, and expenses, okay? And then also indicate the specific item within the accounting equation element that is affected. So pretty much we're just practicing this example on some transactions. Same thing we just did on the bearing of going through transactions A through H on the accounting equation. So let's look here. Received cash from an owner as additional investment of $35,000. So let's think about what the next net effect of that's going to be. We got the answers on the next slide here, but let's just think about it for a minute. If we receive cash from an owner as an additional investment of $35,000, obviously, if we're receiving cash, asset of cash is going to increase. So assets going up. But also, the equity is going to have to go up because it's an additional investment. Let's look and see if this is correct here. Asset, which is cash is an asset, it increases by $35,000. And then the owner's equity, Joel Salvo capital, increased by $35,000, right? Because he just invested the money into the firm, so it goes straight to equity. Straight as an asset, straight as equity. Now, what about if the Salvo Delivery Service paid creditors on account of $1,800? So if we're paying creditors, we know we're going to use an asset, right? Particularly cash. If we're paying creditors, we're going to use cash. So therefore, the asset, cash, is going to decrease, right? And we're paying creditors on account. If we owe creditors on account, then that is hence an accounts payable, which is a liability. So if we've paid creditors on account $1,800, our cash is decreased because that's what we use to pay the creditors on account by $1,800. And therefore liabilities also has to decrease by $1,800 because we paid the creditors on account. So our overall accounts payable balance will be decreased by the same amount as the cash decrease on the payment to the creditors. Let's look and just see if that makes sense. Asset cash decreased by $1,800, right? Because we paid it, money's going out the door, cash is decreasing. And then the liability, accounts payable, also is decreasing by the same amount of $1,800 because recall, when we owe a creditor money, it's a liability. So we're using cash, using asset, decreasing assets of cash in order to satisfy a liability, meaning relieve it or reduce it by the same amount of $1,800. Let's go back and look at the third transaction for the month of February. In the month of February, that Salvo Delivery Services incurred. It says here they billed customers for delivery services on account of $11,250. So if we're going to bill customers for delivery services, okay, on account, so if we're going to bill them, then obviously if we're billing them, then we're going to have a receivable, right? Remember, accounts receivable, we've billed them now. So now it's the flip side of the coin. We don't owe someone, someone owes us because we've actually delivered a good or service, right? And we have not been paid for it. So we're going to count that as an account receivable. So that's asset. It's going up, right? So the asset's going to go up, billed on accounts receivable. And then what's the other side of it? We're going to have the equity, right? Equity is going to increase for the gain, for the revenue, right? So that's going to be the credit. Let's look and see if that's correct here. It makes sense. So assets, accounts receivable is going to increase by $11,250. Remember, the accounts receivable is an asset. Why? Because us, the firm, or the company, the one who is the one actually receiving this asset of an account receivable, we performed a good or service. So we delivered a good or we delivered a service, right? And we did all our performance obligations here. So therefore, we're due that money that we did, the delivery service fees that we did for the service that we delivered to them. So we're going to count that as revenue, right? Because it's money owed to us, but at the same time, we provided a good or service, and that's a revenue producing activity, providing a good or service. So we're receiving accounts receivable. That's an asset because someone else owes us that money, and it's also we're producing a revenue. So we're gonna credit that revenue to the equity of the company by the same amount of $11,250. Now let's say we received cash from customers on account of $6,740. So us, the company, we are receiving cash from customers on account. So what's this mean? So let's look at number 3 again. Remember, we billed customers of $11,250 on account. So we have an asset of a receivable of what someone owes us, right? Because we delivered it on account. We're giving them credit, right? So we're saying that, okay, we trust you that we're gonna do this for you now, but only because you're gonna pay us for it later, right? So. And 4 right here is relating to where we build customers for delivery service. Now we're actually going to receive payment from the customers on account of $6,740. So if we're going to receive payment on account, then obviously we're going to receive cash. Cash is going to go up, right? And accounts receivable will have to go down. So let's look at here. Asset, which is cash, right, increases by $6,740 because remember, cash is your most liquid asset, right? Most liquid asset, it's a current asset, it's cash. We're receiving cash from payment on account. But watch here. Right now, we're pretty much just we're increasing an asset account by reducing another asset account. Because if you recall, accounts receivable, money due from other companies that owe us, that we've already provided the good or service, so we're due that money. So if they owe us that money, then and they've already paid us some of it, then obviously our cash account is going to increase by the amount they paid us. But at the same time, we're going to be working on just the asset side of the equation. We're not even going to the liabilities and equity because we're dealing strictly with assets here. We're receiving cash from the company, but at the same time, their bill or their ticket with us is going down. Their accounts receivable amount is going down. Okay, same thing on their books. Their accounts payable is going down. Okay, and their cash is going down because they've used an asset, cash, to pay a liability. So in their case, their cash is going down and their liabilities is going down. Okay, same as we had on number 2 up there. On number 4 here, we're just on the flip side of that coin. Now we're the ones that are owed the money. So now we're receiving it. So that's why cash is increasing by the amount that accounts receivable is decreasing. Okay? Because if we didn't decrease accounts receivable, then it would be distorted as to the accounts receivable would be overstated, and particularly for that particular customer because we haven't given them credit for paying us the money that they owe us. So it has to stay intact. Just for this particular instance, we're only dealing with only assets, increasing one, decreasing the other. The last one, we paid cash to an owner for personal use of $1,000. So obviously, if we paid cash is an asset, it's going to go down, it's going to reduce our assets, and it's also going to reduce our equity. So cash, the asset, decreases by 1,000, obviously, because we're going to shoot it out to the owner. And the drawing will increase by 1,000. But if the drawing increases by 1,000, the net effect will actually reduce the capital. So there's just some example exercises on the transactions and the effects that each individual transaction can have on the accounting equation of assets equals liabilities plus equities. And I hope everyone understands that. If not, just really go back, hit it again and again and again. Like I said, live it, love it, learn it, enjoy it, because you're not going to get away from it. I cannot stress enough how important this equation is, how much easier our life's going to be. It's better to struggle now on the basics to make individual transactions and other things that we get to later in the semester. It's going to make much more sense if you have a very, very, very good foundation in this. Okay, because it builds very rapidly on top of each other. So really learn this equation. Now let's talk a little bit about financial statements. So after transactions have been recorded and summarized, reports are going to be prepared for users, okay? The accounting reports providing this information is going to be known as financial statements, okay? So financial statements in order of preparation, okay? So order prepared 1 through 4, okay? Financial statement, we'll start with the income statement, okay? So you can see here, the little thing here on the right, it gives a description of what each of those relative statements are. Excuse me. The income statement, we'll start with that one. So pretty much a summary of the revenue expenses for a specific period of time, such as a month or a year. Recall, the income statement is for a specific period of time. Recall, specific period of time. That's how you evaluate the performance of a company. You have to look at it for a period of time. It's done in months, quarterlies, like for example, January, February, March, first quarter, April, May, June, second, and so on and so forth. And then obviously the annual fiscal period is for that of 12 months, okay? Now let's look at the statement of owner's equity, okay? This is going to be a summary of the changes in the owner's equity that have occurred during a specific period of time, such as a month or year. So these changes that take place on the income statement are going to have a direct effect on the changes on the statement of owner's equity, because once again, we're evaluating the changes. So the performance of a company, which takes place on an income statement, which is measured for a specific period of time, all closes and directly relates to the statement of owner's equity. Because that performance, the owner's equity is just like a compilation of all the performances from period to period to period, all added to it. It's closed. That's what means closed to it. The results are closed, so you can start a new period. So that's why the statement of owner's equity is summarizing the changes in owner's equity that have occurred during a specific time period, because it relates to the changes on the income statement, okay? Okay, the balance sheet. This is a list of the assets, liabilities, and owner's equity as of a specific date, usually at the close of the last day of a month or a year, okay? So the balance sheet, notice here, Notice what the balance sheet, what it shows. What have I been hammering down on this lecture? The accounting equation. The balance sheet holds the accounting equation, so therefore it's the cornerstone. This is the cornerstone of all the financial statements. But I want to point out here that it's at a specific date, okay? At a specific point of time, as of a specific date. That way when you see a balance sheet, it could be for company XYZ, balance sheet for the company of XYZ for as of December 31st, whatever the year is, okay? And we know that it's as a specific date because if it as any of the transactions happen, we can see from the earlier in this lesson, we can see that every single transaction that occurs has a direct effect on assets, liabilities, and owner's equity. That is why the balance sheet is only for a point in time, a specific date, because once another transaction has happened from the time that balance sheet has been produced, then it is totally null and void, because that means assets, liabilities, and equities have already moved based upon that one transaction. So it's imperative that we know income statement, statement of owner's equity, as of a period of time, right? We're looking at the performance and how the changes in that performance affected the equity of a company. The balance sheet is just like a snapshot. It's like taking a picture. It's frozen at a point in time. So if you take a picture of someone, the only thing you're going to get is that moment in time. That's it. The minute before or the minute after that picture is taken is totally irrelevant because it doesn't capture anything besides for that point in time, okay? And lastly, we have a statement of cash flows, okay? Statement of cash flows is just a summary of cash receipts and cash payments for a specific period of time, such as a month or year. Okay, so the statement of cash flows is just showing how a company expends cash, right, and receives cash and where they're putting it into. We'll get more into that later. And the statement of cash flows pulls the cash out of a business because businesses account for things on the accrual basis, okay? And the statement of cash flows actually pulls these cash payments and receipts out of the accrual to where we can see where the money's actually being spent. And it's either going to be in operating, investing, or financing activities, in which we will get into at a later point as well. So now let's look at the income statement. The income statement reports the revenues and expenses for a period of time. And this is going to be based on the matching concept. Okay, the matching concept is applied by matching the expenses incurred during a period with the revenue that those expenses generated, okay? So once again, let's talk about this. The income statement is going to be based on the matching concept, okay? So if we're going to actually look and try to evaluate the performance of a company, then we have to match revenues with expenses, okay? Because if we don't, then it's gonna skew the results. So we're not gonna so if we purchase a piece of inventory, if it costs us something in year one, and then we make the revenue from year one, we want to apply that expense with the revenue so we can see how much we really profited off it, right? We're not going to say, okay, we're going to use the expense in year one and we're going to match it with the revenues in year 7 because it has nothing to do with one another, okay? That would just totally just not even make sense. So we want to match those expenses with the revenues because remember, there's a direct correlation and relation between the expenses with the revenues because the expenses is using and consuming assets to be able to produce the revenue. So we need to match those, right? Because it's matching the revenues and expenses. So you need to match those. So remember, the income statement is based upon the matching concept of matching revenues and expenses for a period of time. Okay, the excess of the revenue over the expenses is called net income, net profit, or earnings. So obviously we know if we have more revenue, then the money coming in for the services we provide based upon the expenses incurred to be able to get that money. So if we have more money than revenue or more money coming in than expenses going out, then obviously we're going to be in the positive. Net income, net profit, or earnings. If expenses exceed revenue, then the excess is a net loss. So when you think of net income, that means expenses were less than that of revenues. If you think of net loss, then obviously we're doing something wrong here. We're not bringing in enough money to even cover the expenses. Okay, let's look at an example exercise on the income statement. So the revenues and expenses of Chickadee Travel Service for the year ended April 30th, 2009 follow. So these are the expenses they're talking about for the year, for the month of, for the year ended, year ended April 30th, 2009 for Chickadee Travel Service. So we can see here fees and expenses. Fees earned was $263,200. Miscellaneous expense of $12,950. Office expense of $63,000. Wages expense of $131,700. And now what they want us to do is prepare an income statement for the year ended December 31st, 2009 with this relevant data right here. Okay, so let's start at the very first thing. We'll go ahead and just go to this next slide so you can get a visual as I'm explaining it. So based upon this data, we're gonna plug in and create the income statement. Let's first here look at what the title says. Let's really hammer down on this so we know the difference on the time periods here. So this is Chickadee Travel Service income statement, and notice for the year ended December 31st, 2009. Notice it says for the year ended. So this means this is for the period of 2009, for this whole entire year. This is the activity that occurred during this period of time, right? Because for the income statement is for a period of time. So for the year ended December 31st, 2009. Recall we had fees earned of $263,200. So we first always start with revenues on the income statement, okay? Next, we have expenses, okay? Wages expense of $131,700. Then we had an office expense of $63,000. We had a miscellaneous expense of $12,950. Then as you can see here, we have it tallied over here. These three expenses sum up to be $207,650. Obviously, if we take the fees earned of $263,200 less the total expenses right here, which are itemized right here, these just are breaking down where you get this total right here. So if we back $207,650 from $263,200, it'll leave us with net income of $55,550. Recall it's net income and not net loss because fees earned were greater than total expenses incurred. So basic, remember, income statement for a period of time, in this case for the year of 2009. This is the activity that occurred during that period, and this is how we account for it to evaluate the performance of the company for this period of time. We start with the fees earned, then we back out the expenses, and it'll give us our net income or loss. Next, let's look at the statement of owner's equity. Statement of owner's equity reports the changes in the owner's equity for a period of time. Once again, for a period of time. It is prepared after the income statement because the net income or net loss for the period must be reported in this statement. So let's look at a little example exercise here in regards to the statement of owner's equity. Using the income statement for Chickadee Travel Service shown in example exercise 1 through 4, prepare a statement of owner's equity for the year ended April 30th, 2009. Adam Salini, the owner, invested an additional $50,000 in the business and withdrew cash of $30,000 for personal use during the year. The capital of Adam Salini was $80,000 on May 1, 2009. And right here, the dates are a little off. I don't know if this is a misprint here or what it is, but let's just look at here down at this statement of owner's equity here. Let's start with the title of it up top. Chickadee Travel Service Statement of Owner's Equity for the year ended December 31st, 2009. Because remember, this is for a period of time, same as that of the income statement, for this period of time. Because recall, beginning balance, this is pertinent data right here. The capital was $80,000 on May 1, but here it's saying January 1. So we'll just say January 1 here. That's beginning balance, $800,000, okay? So there's our beginning balance. So the additional investment by the owner during the year, this is, remember, we're accounting for the activities that occurred during the year. Remember, the investment by the owner during the year, the Adam Salini invested additional $50,000, so we're going to add that in. Net income for the year, if you recall, was $55,550 based upon our income statement that we built. Because remember, net income is closed to owner's equity, meaning retained earnings. So this would be like the retained earnings for that period. So there's the investment by the owner added. The net income is carried over into this because that's going to increase equity. And remember, recall the withdrawals or the drawings of $30,000 for personal use, right? So that's going to be backed out. So increase in owner's equity for the period is $75,550. You derive this number, or you can calculate this number based upon the net of these numbers. You add 50 plus 55,550 and then less 30,000, you're going to get a net of 75,550. From that point, we're going to take the beginning balance as of January 1 of 80,000, add in the net effect of the increase in owner's equity for the change in the period of 75,550, and then that'll give you the capital as of December 31st, 2009 year end. So you take the beginning balance, take the changes that occurred during the period, and then you take and add or subtract whatever it is, and then that'll give you the ending balance right here. Pretty straightforward. Remember, this is for a period of time, evaluating the changes in equity for a period, just as is for the income statement. Remember, we build the income statement first because it has a direct effect on the statement of owner's equity. The statement of owner's equity follows because the income statement closes and has a direct effect, or is meaning closed, so the end result is moved here, so the income statement can start back at 0 for the next period, and then it can be closed here and be accumulated in the statement of owner's equity and account for the changes from here. So obviously this ending balance here at December 31st, 2009 is going to be our beginning balance for the next year, for the 2010. And then we're going to go through the same song and dance over and over and over. That's how this works. Okay, now let's talk about the balance sheet. A balance sheet is a list of the assets, liabilities, and owner's equity as of a specific date. Recall, the balance sheet is going to have all the accounting equation on it. That's like I said, once again, that's the cornerstone of all the statements. But recall, it's like a picture, it's like a photograph. It's only for a specific date, for our actual point in time. Okay? Anything that happened after it is anything like a transaction after that point in time, the balance sheet is no longer relevant because it's changed. And like I said, we can infer this, and we know this because of the transaction effects on the accounting equation that we had. Remember, if we paid off an account payable, it reduces our assets of cash, and it also reduces our liability of the account payable by the same amount, keeping our balance in check. So that's why the balance sheet is a list of assets and liabilities and owner's equity as of a specific date, as of a point in time. Okay, the account form of a balance sheet lists the assets on the left and the liabilities and owner's equity on the right. So once again, this is going to resemble the basic format of the accounting equation. Because remember, assets equals liabilities plus owner's equity. So there you see the account format on the balance sheet. So once again, like I said, that's why this accounting equation is so imperative that you know it. It's going to make your life so much easier. I cannot stress that enough. Okay, let's look at this little example exercise here, the balance sheet. Using the following data for Chickadee Travel Services, as well as the statement of owner's equity shown in example exercise 1 through 1.5, prepare a balance sheet as of April 30th, 2009. Okay, so they've given us the information here, so we don't have to go back and look at it. You can see we have accounts payable, $12,200. Accounts payable is a liability. Accounts receivable of $31,350. That's an asset. Cash, another asset. Land, another asset. Supplies, another asset. Okay, now let's just go ahead and build this balance sheet. Let's take a look at the title to start with. Chickadee Travel Service, balance sheet. And recall the date. Notice this one is just December 31st, 2009. So this is as of December 31st, 2009. Not as for the period of, just like on a statement about changes in owner's equity or on the income statement. But recall the balance sheet is at a point in time. Okay, it's just a snapshot of the financial position of a company as of December 31st, 2009. So that's why I keep stressing the title here. Okay, let's start with assets. Remember that they're wanting us to build a balance sheet based upon this data here, okay? So this is why we have to know the difference between assets and liabilities and equities. So remember, balance sheets, they're listed in the order The same order, assets on the left-hand side, liabilities and equities on the right to resemble that of the accounting equation. So let's start off and just list our assets, okay? Assets, we'll start with cash, okay? $53,050. Accounts receivable is next, $31,350. Supplies, $3,350. Land, $80,000, which makes up a total assets of $167,750. I want to point out something here. The order in which these assets are listed is the order of liquidity. Okay? Cash is the most liquid, with accounts receivable being next. Supplies next, land. So that's how assets are going to be listed on a balance sheet in the order of liquidity. Whichever asset is most liquid is listed first. Obviously, cash is the most liquid asset of them all. Next, we know we need to talk about liabilities. The accounts payable, we know, are $12,200. Okay? So we can infer just from this data, even though we did not see what the equity is, okay, just from knowing what the assets and liabilities are, we can solve what the actual owner's equity is, even though it's given in one of the previous examples earlier, because we're using the data that we've went through and worked through earlier in this lesson. So the owner's equity has to equal the $155,550, which is the difference between the $167,750 of assets and the liabilities of $12,200, because recall, assets has to equal liabilities plus owner's equity. So $12,200 plus $155,550 is the same as $167,750 for total liabilities and owner's equity. So we see total assets, $167,750. Total liabilities and owner's equity, $167,750. Because remember, we have to be in balance. The equation is always, it must balance or something's wrong. Okay, next let's talk about the statement of cash flows. A statement of cash flows is a summary of the cash receipts and the cash payments for a specific period of time. The statement of cash flows is going to consist of 3 sections. We have the operating activities, investing activities, and financing activities. Okay, cash flows from operating activities, pretty much, this section reports a summary of cash receipts and cash payments from operations, right? So pretty much items on the statement of cash flows that's going to be built up the operating activity section is going to be based upon income statement accounts, income statement activity, operating activity. Because remember, operations are going to be reported through the income statement, right? So obviously, cash flows from operating activities can be based on the activity from the income statement. Cash flows from investing activities. This section reports the cash transactions for the acquisition and sale of relatively permanent assets. What do we mean by permanent assets here? So if the acquisition and sale, so let's talk about property, plant, and equipment. So anytime we buy land or machinery or vehicles, stuff of that sort, or even investments and available for sale investments, stuff like that. These are investing activities. So the cash proceeds and the cash disbursements from activities such as buying equipment, land, buildings, whatever it might be, those are going to be accounted for in investing activities, okay? And then the last section is the cash flows from financing activities. This section reports the cash transactions that relate to cash investments by the owner, the borrowings, and withdrawals by the owner. So pretty much cash flows from financing activities deal strictly with the financing, okay? So if we're obtaining a loan from a bank, okay, financing. We issue stock, financing. Bonds, financing. Anyone pulling money out, financing, okay? So statement of cash flows. Easy way to remember the 3 sections: operating, investing, financing. OIF, OIF. Operating, investing, financing. Always in this order. Operating always first, investing always second, financing always last. Okay? Now let's look at another example exercise for the statement of cash flows. So a summary of cash flows for Chickadee Travel Service for the year ended April 30th, 2009 follows. So right here, we have cash receipts, so money coming into the company is cash received from customers. Then we have cash received from additional investment by an owner. The cash payments are cash being spent by the company, cash going out, cash paid for expenses, cash paid for land, cash paid to owner for personal use. Okay, the cash balances as of May 1st, 2009 was $72,050. They want us to prepare a statement of cash flows for Chickadee Travel Service for the year ended April 30th, 2009. Okay, let's just go on and jump to this one here, okay? If you recall, remember cash flows used for operating activities, okay? So remember operating activity, this is going to be stuff on the operating side of things that we'd most likely see on the income statement, remember? So remember the cash received from customers, that's going to be an operating activity, right? Because it's within our normal course of operations. You know, we sell them something, they pay us for our goods or service that we provide them. So that's an operating activity. So the cash received from customers is going to be an increase in the cash, inflow to cash for the operating activities. Cash paid for expenses. Recall expenses is an operating activity. Expenses is how we generate revenue. It's based on the income statement. That's how we track them. That's why it's going to be an operating activities. Expenses like wages, utilities, stuff like that we've already discussed, interest, all these things are going to be paid, and it can be expenses related to operating activities. Those are going to be outflows. So from that point, we need to look at the net cash flows from operating activities. The net cash flows is going to be $41,000. The positive 251 coming in, the negative 210 going out. It's going to be the net cash flow will be a positive 41,000. Next, we go to the next section, the investing activities. Cash flows from or used for investing activities. Recall, investing activities, what is it? We're buying property, plant, and equipment, or securities, or investments in bonds, stuff of that sort. That's investing activities, and dispositions with company assets of vehicles, stuff like that sort. So we see cash payments for the purchase of land. Obviously, that's an investment in a fixed asset, in land, in the property. So that's going to be a cash outlay or cash outflow, cash used for investing activities. So right here, so cash payments used for purchase of land is $80,000. So there's that. Now let's look at the financing activities. Cash flows from or used for financing activities. Cash received from an owner as an investment. That's $50,000. So obviously we know it's a source with an owner. Cash received from an owner as an investment. That's $50,000. That's a financing activity. A withdrawal from an owner. That's also a financing activity. It's going to reduce it. So the net cash flows from financing activities will be $20,000. From there, we can find out what the net increase or decrease in cash is from the three different types of activities: the operating, investing, and financing activities. We can see here. 41,000 positive for the operating, 80 negative for the investing, and 20 positive is going to give us the net decrease in cash of $19,000, because 41,000 minus 80,000 plus 20,000 is negative $19,000. So it's a net decrease in cash. Okay, so there's the change in the year between the different types of business activities, whether it be in operating, investing, or financing. Then we have the cash balance January 1, 2009 of $72,050. If you recall, they told us at the end here what it was. That's why that's pertinent as of the beginning of the year. So that's why it's the beginning of the year. And then we have the cash balance as of December 31st, 2009, $53,050. And that is merely just the net decrease or increase in cash. In this case, it's a net decrease. We want to add that to the beginning balance, and then at the end, it'll give us the net result of what the cash balance will be at the end of the year right here. So that's the statement of cash flows. Remember, it's for the year ended December 31st, 2009, because it's for the actual period of time dealing with money, whether it's being spent operating, investing, or financing. It tells you the change for the period, what it was at the beginning, and then what it is at the end. Okay, now let's look at what these financial statements for Net Solutions are going to look like. And we're going to see how they relate to one another or how they interact with one another. So Net Solutions income statement for the month ended November 30th, 2003. So recall, it's for the month ended for the period of time. In this case, it's a month, an interim period. Fees earned, we always start with the fees, $7,500. Then we have the relative expenses categorized here for the make up the total expenses here of $44.50, and leaves us a net income of $3,050. Okay, recall that we build the income statement first. Okay, now that we have the income statement built, we see what the results of operation for the month of November 30th ended up being. In this case, we had positive income, net income of $3,050. Now recall, the net income has a direct effect. Remember, revenues and expenses have a direct effect on the owner's equity, right? So how is that so? Remember how I keep saying net income is close to retained earnings? Well, here's what I'm talking about. See this figure here in blue, the $3,050? That's our net income from the results of operation. We're going to carry that down into the statement of owner's equity. So let's say Chris Clark Capital November 1. So that was the inception of the company. They had nothing here. Remember, he made that investment on November 1 of $25,000. So that increased statement of owner's equity, increased equity, right? Now, net income for the month of November is closed, meaning it's closed here. So these accounts can start over for the next month, and it's closed to retained earnings, which is the net income for November. So this is also going to increase it because remember, there's a direct relation between the revenues and expenses, which has a direct effect on whether it's an income or loss for the period. The income or loss for the period is then closed to the statement of retained earnings or statement of owner's equity. Okay. So you can see the net income. Remember, the beginning balance was nothing. He contributed to it $25,000. Here's where the net income is closed or carried over to the statement of owner's equity. And then here's the owner's withdrawal. So that's going to decrease it. Once again, the increase in owner's equity for the period for the month ended November 30th was a net effect of $26,050. So Chris Clark's capital on November 30th, 2003 is $26,050. That's what the equity account says, because of the change in equity through the period. Okay, now let's see here. We've carried the statement of owner's equity down just so we can see how they continue to carry on and how the statements interact with one another or communicate with one another, whatever verbiage you want to use here. Okay, so once again, we're looking at the statement of owner's equity. Recall that net income for the income statement closed or was carried over into the statement of owner's equity. We worked through to get the net result of the end of the owner's equity of $26,050. Okay, the statement of owner's equity, remember, equity is part of the accounting equation. Assets equals liabilities plus equities, right? So this ending equity as of November 30th, 2003 is going to be carried all the way down into the owner's equity section of Chris Clark's Capital, owner's equity. So there's how you can see the ending balance right here in the equity section. I'm sorry. The ending balance here in the equity section. We can see here all this relevant data here on the balance sheet. We have the assets equals liability plus owner's equity. I'm just showing you here how they tie in. Okay, now we're carrying the balance sheet down, okay? So we knew this carried over from the owner's equity. This shows the actual owner's equity. We have a statement showing the breakdown of how it changed from the period, which was also built upon from the income statement. Okay, now let's look at how the balance sheet ties in with the statement of cash flows. So notice the assets, because remember the balance sheet, which is for a specific point in time, it displays our assets, liabilities, and equity, the accounting equation. Well, notice here, cash, which is a current asset, the most liquid asset, so therefore it's listed first, of $5,900 right here. Well, that $5,900 should match to the cash balance at November 30th, 2003 on that of the statement of cash flows. And that's going to be derived from all the cash used or brought in from your operating, investing, and your financing activities. So that ending cash balance should directly match what your cash balance is here on your balance sheet. Okay, report form of balance sheet. Net Solutions balance sheet, remember at a point in time, cash $5,900, supplies $550, land $20,000, total assets $26,450. Remember we had the liabilities of $400. And now we have the owner's equity of $26,050. So total liabilities and owner's equity matches that of the assets of $26,450. I hope that shows a good way that these financial statements interrelate with one another. And right here, that gives you a little visual. So let's just read through this little chart here for a second. So the financial statements, income statement and statement of owner's equity. What's the interrelationship between the two? Net income or net loss reported on the income statement is also reported on the statement of owner's equity as either an addition, which would be net income, or a deduction, net loss from the beginning of owner's equity, and then any additional investments by the owner during the period. We saw that already on the statement of owner's equity. This is just giving you the actual text version of it, so you can see it both ways. Net Solutions net income of $3,050 for November was added to Chris Clark's investment of $25,000 on the statement of owner's equity. So we saw this. Next, the statement of owner's equity and the balance sheet. The owner's capital at the end of the period reported on the statement of owner's equity is also reported on the balance sheet as owner's equity or owner's capital. And once again, we saw this Net Solutions example. Chris Clark's capital of $26,050 as of November 30th, 2003 on the statement of owner's equity also appeared on the November 30th, 2003 balance sheet as Chris Clark's capital. Next, the balance sheet and the statement of cash flows. Remember, the cash reported on the balance sheet is also reported as the end of the period cash on the statement of the cash flows. Once again, we saw this in Net Solutions example, Exhibit 8. The cash of $5,900 reported on the balance sheet as of November 30th, 2003 was also reported on the November statement of cash flows at the end of the period of cash. So let's talk a little bit about financial analysis and interpretation. So a little bit about ratio of liabilities to owner's equity. So the ratio of liabilities to owner's equity is useful in analyzing the ability of a company to pay its creditors. So the ratio of liabilities to owner's equity is going to be computed as follows. So pretty much, here we can see the actual formula right here. Ratio of liabilities to owner's equity is pretty simple. Liabilities to owner's equity. So obviously, total liabilities is going to be your numerator, meaning the one on top of the equation, and your denominator, the one on the bottom, is going to be total owner's equity or total stockholders' equity. Makes sense. Pretty easy ratio to remember. Ratio of liabilities to owner's equity. So pretty much liabilities over owner's equity. Liabilities is your numerator, total equity, total owner equity or total stockholders' equity is your denominator. And once again, this is useful in analyzing the ability of a company to pay its creditors. Let's just put in a little bit of numbers here that we have from Net Solutions ratio of liabilities to owner's equity at the end of November. Let's just see what we get here. So the ratio of liabilities to owner's equity, we know that they had total liabilities of $400 and total owner's equity of $26,050. So rounded, that's going to be 0.015. So let's look at this example. The following data were taken from Hawthorne Company's balance sheet. Okay, we can see here, always pay attention to the years here. Sometimes it might be listed different. In this case, December 31st, 2004, this was the total liabilities as of that date. Then we can see the change from 2004 to 2005 was it increased $15,000 up to a total liabilities of $120,000. Same thing here, total owner equity on December 31st, 04 was $75,000. We'd increase over the year from 2004 to 2005 of $5,000. So the ending balance here is $8,000 on total owner's equity. So once again, compute the ratio of liabilities to owner's equity. We want to do that, and they're asking, has the creditor's risk increased or decreased from December 31st, 2004 to December 31st, 2005? Okay, so let's take a look at this. Let's see here. Once again, here's our numbers. Part A, what they were asking us. Remember, December 31st, 2004 to December 31st, 2005, liabilities increased $15,000 from 105 to 120. Total owner's equity increased from December 31st, 04 to December 31st, 05, $5,000 from $75,000 to $80,000. So obviously the ratio of liabilities to owner's equity, recall, is just literally your liabilities is your numerator, your owner's equity is your denominator. In this case, it'd be 120,000 divided by 80,000 is going to be 1.5 for 2005. For 2004, it's going to be 105,000 divided by 75,000, which is 1.4, which is okay. So we see here. In the case of the question, has the creditor's risk increased or decreased from December 31st, 2004 to December 31st, 2005? It's increased here. Why do we think it's increased? Let's just look at here. Total liabilities increased 15,000, whereas equity only increased 5,000. So the equity of a firm only grew 5,000, where the liabilities or responsibilities increased by 2/3 that amount. So obviously, the risk is going to increase because now there's less equity as opposed to liabilities. So now the firm owes more but has less equity to be able to resolve those liabilities. So it's more risky now. So the risk is actually increased. So that's how you can use the ratio of liabilities to owner's equity, kind of assess once again, analyzing the ability of a company to pay its creditors. Okay, so obviously, the higher the ratio of liabilities to owner's equity, the more risky. Okay. This right here sums up chapter 1, which again, chapter 1 was the introduction to accounting and business. Out of the learning objectives, I would say the single most important thing you can learn, obviously it's all important, but the accounting equation, know it and know the effects that the elements have on the accounting equation. Start learning the difference between assets and liabilities. Read chapter 1. It'll go into more detail than what I just went over. But long and short, that's what this chapter consists of here. I hope this video lecture was helpful. So that sums up chapter 1. Let's just jump over here to Moodle page again one more time. Let's see here. So once again, this is top of the page. Recall the syllabus is here. Please read it before you start the coursework. There's an introduction video to the course. It goes over the syllabus and a little bit over the shell on what's expected out of everybody. So if you haven't watched that, I suggest watching that as well. Once again, there's an introduction assignment here that needs to be due no later than this Saturday on August 22nd by 11:59 p.m. It's very simple. It's going to take about a few minutes. Just introduce yourself to the class. Once again, here's the PowerPoint. And today I'll be posting this lecture right below this PowerPoint here. So what I just went over today, I'm going to be posting right here. That'll be the same way I do it. There'll be a link available. It does still have to download to YouTube, however. So if you click on the link and it says, check back later, just check back later, and it'll be available once it's downloaded. I'll also be on the lookout for Chapter 1 homework and Chapter 1 quizzes. I will be posting those very soon. Those are not due until the end of next week on August 28th. I purposely did that to give time for people to get their books and get situated in the class and everything before an assignment was due. But please do this introduction because that's imperative once again for financial aid disbursements and even being able to stay in the course. So that's it. That's it for chapter 1. I hope everyone has a good day and a good rest of their week. Once again, be on the lookout for the video as it becomes available. The link will be below the PowerPoint link. And then once again, homework and the quiz will be available as well here very shortly. Once again, if anyone has any questions or concern or didn't understand anything, here's my office hours, my email address. Reach out to me. Once again, email is the preferred method, quickest turnaround for response. So hope everyone has a good day. Thanks for your time, and I will see you next week.